Welcome to this explainer. Look, if you're gearing up to buy your first home, I know exactly how you might be feeling right now. You're staring down the 2026 housing market, you're checking your bank account, and honestly, your stomach's probably in knots, right? There's just so much anxiety around buying a house, and the internet, well, it's packed with terrifying and completely conflicting advice. But I'm here to tell you, as a mortgage expert, I've literally seen it all. And my goal today is to put your mind completely at ease. We're going to break down the actual reality of home qualifications and show you exactly how accessible this whole process really is.
So, let me ask you something directly. Are you letting the idea that you need this pristine 720 credit score and a massive 20% down payment keep you trapped in the renting cycle? I talk to people every single day who just assume they're totally locked out of homeownership because they don't meet these arbitrary textbook standards. They look at a $300,000 home, do the math for a $60,000 down payment, and just give up before they even start.
We'll take a deep breath and really hear me when I say this. You don't. You are in safe, expert hands today. The rules of the game are way more flexible than the flashy headlines suggest. Look, the anxiety you're feeling, it's completely valid, but it's based on outdated information. Today, we're going to replace all that anxiety with actual, verified financial strategies.
Okay, let's dive right in and dismantle the absolute biggest barrier first, the 20% down payment myth. The reality? The median down payment for first-time buyers is actually hovering right around 10%, and the absolute minimum you need? Often just 3 to 3.5%. And what about your credit score? It definitely does not need to be perfect. There are major government-backed programs built specifically to catch buyers who just don't fit that flawless mold.
Which brings us to Section 1, the FHA Lifeline.
So the Federal Housing Administration Loan, or FHA loan, is the most widely used first-time buyer program in the country, and honestly, for very good reason. It is an absolute lifeline if you've got limited savings or, less than perfect credit. Now, it's not a direct loan from the government, but rather a government-backed mortgage, and that backing allows lenders to offer incredibly flexible qualification terms. If we compare it to conventional loans, which usually demand at least a 620 credit score and 3% down, the FHA steps in with some serious flexibility. If you've got just a 580 credit score, you can still get in with a 3.5% down payment. So one lender's no on a conventional loan is absolutely not the end of the road.
Now, FHA loans are amazing, but, we've got to look at the full picture here. Because the FHA is taking on more risk by allowing scores as low as 580 and exceptionally high debt-to-income or DTI ratios of up to 50%, there is a trade-off. They do require a mortgage insurance premium. So there's an upfront fee of 1.75% plus an annual 0.55% fee. And yeah, sure, this makes the loans slightly more expensive over time, but it forgives that higher debt-to-income ratio. It's essentially the crucial stepping stone to get you out of renting and into building your own equity.
Moving on to Section 2, free money and hidden tax hacks.
Now that we've tackled the loan itself, let's talk about how we actually fund it. There is real money set aside for buyers at the federal, state, and local levels that so many people completely leave on the table simply because they don't know it exists. But first, we kind of need to redefine who actually gets this money. Under HUD guidelines, a first-time homebuyer is anyone who hasn't owned a primary residence in the past 3 years. Listen to that again. You don't actually have to be a brand new buyer. If you owned a home, sold it, and rented for a few years, boom, that 3-year rule resets your eligibility entirely. You're back in the club.
And because you're in that club, you've got access to down payment assistance, or DPA, grants. This is a massive insider secret. These are state and local funds designed to help cover your upfront costs. And the absolute best part? If they're structured as grants, they often convert into a full financial gift that you never, ever have to repay. The catch? You usually just have to stay in the home for 3 to 5 years. It is quite literally free money just for staying put.
Now notice that massive number right there, $30,000. That represents the potential 10-year federal tax savings of another hidden tool called a mortgage credit certificate. While everyone out there is arguing over interest rates, almost no one is talking about this incredible wealth-building hack.
Let's break down this MCC math slowly because it's huge. Issued by state housing agencies, a mortgage credit certificate lets you claim a portion of your annual mortgage interest directly against your federal tax liability. So imagine you pay $12,000 a year in mortgage interest, and your state allows a 25% MCC credit. That quietly saves you $3,000 on your taxes every single year. Over a decade, that compounds to $30,000. It's a credit that literally stays with you for as long as you live in the home.
Which brings us to Section 3, the magic of stacking.
Okay, so we know about the FHA Lifeline, we know about DPA grants, and the MCC tax credits. Now it's time to empower you to act like a true real estate insider. The single biggest mistake buyers make is thinking they have to choose just one of these. No way. The real magic happens through a strategy called stacking. That's combining these disparate programs into one single, incredibly powerful deal. And here is your 3-step, totally achievable recipe for success. Step 1, we get you approved for that flexible FHA loan. Step 2, your lender simultaneously applies for a state down payment assistance grant. And Step 3, at that exact same closing table, we claim your mortgage credit certificate. The whole shebang happens at once, completely coordinated by your loan officer.
Let's ground all this emotional reassurance in some cold, hard facts. Look at this exact math for a buyer in Georgia. Say you find a $300,000 home. The FHA 3.5% rule requires a $10,500 down payment, but your lender stacks a state DPA grant that provides $10,000. Your actual out-of-pocket contribution for the down payment? Just $500. The myth of needing $60,000 is completely busted.
Now, as your expert guide here, I've got to be completely transparent with you about the hidden reality of the closing table. Down payments aren't the only upfront cost. As this excellent guide from the North Carolina Housing Finance Agency points out, you also have closing costs to think about. You really need to prepare for things like attorney fees, home appraisals, loan origination fees, title searches, recording fees, all that fun stuff. But again, do not panic. While these are extra, DPA grants, like the North Carolina Home Advantage Mortgage, which offers up to 3% assistance, can be strategically used to free up funds to cover these exact fees. That way, you aren't caught off guard at the very end.
All right, moving to Section 4, the ultimate shield, pre-approval. So you know the math and you know the programs. Now we move to the final, absolutely crucial step of preparation. Before you ever step foot into an open house or, fall in love with the property online, you need your ultimate shield. We've got to clearly separate two terms that get thrown around a lot. A pre-qualification? That's just a flimsy, educated guesstimate. It's basically a lender saying, well, based on what you told us, sure, you might afford this. But a pre-approval, oh, that is a verified, rock-solid shield. That means the lender has actually pulled your credit, verified your income, checked your assets, and is formally backing you.
And this is exactly why a true pre-approval matters so much. It can make you almost as strong as a cash buyer.
I mean it.
In a competitive market, a seller won't even look at an offer if it isn't backed by verified proof. Getting this done arms you to shop with absolute authority. You'll know exactly what you can afford, and you'll prove to the seller that your money is good to go.
So let's wrap this all up. You now know that the 20% down payment is a total myth. You understand how the FHA Lifeline works, you know how to stack free DPA grant money with federal tax credits, and you know you absolutely must get a verified pre-approval before you shop. You have the tools, you know the insider secrets, and the money is quite literally out there waiting for you. So, what's stopping you from getting off the sidelines, overcoming that anxiety, and finding your home in the 2026 housing market? The door's wide open. Now it's time for you to walk through it.